Good afternoon, everybody. This is Fahad. Today is Thursday, May 21st. I have Chronicle with me. Hi, Chronicle. How are you doing?
Fahad, I'm good, thanks. How are you?
I'm doing great. We have been on this path of producing various pitches on the Jaguar Media website. We have done two of those in the recent weeks, and now you have a third one. This is a long idea on United Parcel Service, UPS. Tell me about it. What have you been working on, and why is it on your radar at this time?
Sure. So on the long side, I think if we're going to start reopening economies globally, I suspect manufacturing and transportation will recover faster relative to services. As we touched on all week, this could partly be why manufacturing PMIs have come in relatively better than services PMIs. And when I look at various leading industrial economic indicators, they haven't dropped as much against the baseline when compared to, say, restaurants and retail foot traffic, for instance. So that's telling me there are pockets of relative strength here. On the next slide, we can see from the chart, while many services remain impaired and will require transformations or hard resets, we're seeing news of factories We're seeing news of factories and logistics getting restarted without excessive complications.
There is a real good argument to be made here, and we have been talking a lot back and forth about this internally in our team as well, that the manufacturing will likely come back faster as we start to recover from these shutdowns than the service economy. I think there's a lot of I think there are a lot of zombie companies essentially that are now in the service economy that are going to have a very tough time emerging back to any kind of normalcy that will make sense. But let's suppose a simple factory shipping things around. I think there's much easier to abide by social distancing, and a typical manufacturing sector should have an easier comeback. Do you agree with that? And if so, how long of a timeline would you put on it in terms of how quickly it could come back? 6 months, 3 months, a year?
Firstly, I totally agree with what you just said. A lot of services aren't necessarily going to make back lost sales immediately, whereas within manufacturing, within pockets of manufacturing, inventory has gotten worked off, and so I can see a ramp in certain areas. In terms of timeline, I think it happens right away. I think the ramp happens right away.
This morning, we got the manufacturing flash PMI for the month of May for the United States, and overnight, we got the European PMIs as well. And there's one thing consistent in all of them. While in absolute terms, these numbers are just absolutely hideous, anything below 50 is contraction. But sequentially, at least from April to May, they are indeed bouncing back a little bit. It could still be a road to recovery of several months before they flip back to above 50 levels, but the trend is definitely noteworthy. Keeping along on the discussions on Amazon, tell me what stood out for you for the last earnings report that you saw, and what else are your thoughts on this one?
Yeah, so first of all, I'll give a backdrop. As we can see from the graphs below, I'll start by saying Amazon's move to minimize delivery times and slash costs has resulted in UPS's margins getting squeezed. And so the bear case for the last couple of years has been that UPS's revenue has gone up steadily while EPS hasn't. Most recently, the company reported Q1 earnings of $1.15, which is down 5.7% year over year, and revenue of $18.04 billion, which implies 4.3% growth year over year. Looking ahead, 2020 earnings estimates have been slashed from $7.77 in mid-March all the way down to $5.45, which implies roughly 7.5% year-over-year growth. And revenue estimates are now at $73.97 billion, which implies flat growth. Generally, I think market sentiment on the stock has been too bearish. And while I wouldn't consider holding UPS as a long-term investment, I'm willing to get long for a near to medium term trade, targeting around $110, because I think a mild recovery is doable due to three tailwinds. Sorry.
And what are those three tailwinds?
Sure. If we go to the next slide, first off, UPS has been designated by governments globally as a critical infrastructure business and continues to operate in all major countries. The company is assisting customers like 3M, Medtronic, and McKesson to distribute supplies and PPE. This helps to pad some of the COVID-19 headwinds. Secondly, e-commerce has performed better than expected, and I think consensus hasn't fully priced in the degree of permanence this growth will have. And if we were to break down UPS earnings in terms of both cost and sales, from the cost side, UPS invested about $5.1 billion the last couple of years to improve its efficiency. Specifically, the company added dozens of new facilities globally while automating existing facilities. They also integrated AI and software logistical planning to improve efficiency, while also deploying UPS Nav, which is geared towards supporting the increase in residential volume. Put together, the company says these actions have increased delivery efficiency by 30% at midpoint, and the software planning upgrades are estimated to result in $75 million in savings annually beginning this year. So that's the cost side of the equation. From the revenue side, in Q1, the company says e-commerce volume grew 12% internationally, while domestically it grew 19%. For a large cap, those are pretty decent numbers. And additionally, as China began to recover in March, the company's Asia outbound business accelerated for both air freight and small packages. Despite all this, it looks like sell-side analysts are still not convinced about margins if we look at their most recent notes. But I
Yeah,
think they are missing, sorry.
Yeah, and I see that exactly myself on the street too. It is noteworthy though that the company did suffer a stunning decline in margins of 310 basis points year over year in the domestic business, and the international margins were also down by 200 basis points. That was in the last quarter, and I think that turned off a lot of analysts. But to your point about companies spending on efficiencies, despite seismic changes in the demand landscape, some of which could prove to be structural in nature, UPS is really not pulling back the throttle on efforts to capture growth from small and medium-sized businesses. I mean, doing some more reading on this one, the company is really pushing forth with initiatives to speed up the network and expand weekend delivery options, for example. So even though they cut the capex by 15%, which could potentially bring the margins back to more normalized level, they've basically shifted their capex to focus more on improving efficiencies than rather expanding geographical markets. So I tend to agree with you that I think that consensus may have drastically taken down margins in the short term, spooked by what the company said in the first quarter, but that's possibly short-term phenomena. Do you agree?
Yep, I agree completely. And I think on top of that, they're missing several other important factors here. First of all, international markets are reopening their economies before the US. And what's key here is that UPS's operating margins for international shipping is 17%, about double of that of domestic shipping. And this, I think this is mainly because Amazon is still a minor player when it comes to global freight. So they can't exactly eat into UPS's margins abroad. And I would also add that fuel costs have come down drastically, which is good for margins. Fuel is roughly 5% of UPS's operating expenses, which could potentially result in up to 2% in savings for this quarter and 1.5% in Q3 based on futures. And another thing is that Amazon's split from FedEx has stealthily resulted in a gradual increase of Amazon related revenue for UPS. going from high single digits in 2018 to 11.6% most recently in 2019. So as long as Amazon does well, UPS should continue to see a benefit.
Yeah, and talking about that, we recently in one of our conversation videos that we post in the morning, we talked about the stealth acceleration that we are seeing in the penetration of e-commerce trends in the United States during the shutdown period. It took 10 years for the e-commerce penetration in the US as a percentage of total retail sales to go from 5% to 10%, 5% to 15%. It took 10 years at an average rate of 1% per year. And then after that, it took only 8 weeks to add another 10% penetration on top of it. More people buying online, more e-commerce, all of that simply means more boxes being shipped, and UPS is the single biggest driver of that because UPS is now the exclusive provider with Amazon. FedEx has been basically thrown out of that mix already a while ago. So I like that. Particularly, I like the idea about margins improving, especially on the fuel cost. I mean, it's actually the numbers are out there. So I think the street has may have just gone too much aggressively bearish and now is possibly going to bounce back after the second quarter results come out, and they're going to have to they're going to have to re-up their expectations at a higher rate once the second quarter earnings is released than what they did after the first quarter. On the third point, tell me about this healthcare division.
Sure, that's the third tailwind. This healthcare division began with the Marken acquisition not too long ago. So this division is seeing accelerated volume and operating profit growth. In addition to increased on-delivery demand for essential goods and PPE, management is also building on UPS Premier, which is the next-gen technology for critical healthcare shipments. In late April, this subsidiary teamed up with CVS to begin delivering prescription medicines via drones to America's largest retirement community in Florida, which houses over 130,000 residents. Separately, this subsidiary is also working with various organizations to determine how technology can help provide health providers respond quickly to medical needs. Put together, this entire healthcare division saw accelerated volume growth of 8.9%, and the CFO said that no other industry verticals had positive commercial growth in March quarter except for healthcare. In fact, operating profit growth in logistics was led solely by US healthcare as Marken had a strong quarter of double-digit revenue growth and profit acceleration. And going forward, who knows what other applications this might have.
Yeah, I think this is one of those sleeper segments, I would call it, inside UPS that potentially could become a major lever of growth going forward. This only started recently and then it just took off. So, and I think there are varying number of ways they can go. They can expand from not just in healthcare into many other side industries with the drone delivery service. It's always been the vision even of Amazon as well. And I think that one of the positive outcomes of this health crisis is essentially an acceleration in drone delivery service as well. And I wonder how that plays into better and better, stronger margins in the future as well. So great thought on that one. Now looking technically on the chart, so right now, this is a interesting trend here. The stock has been bouncing off the 88, $90. It has come up a little bit now. It's trading at 97. You think it still has more upside? This can go all the way to 112.
Yeah, putting everything together, I think there is a case to be made for a temporary rally. Sell side consensus, as we said, is firmly bearish, and judging by where the stock is currently trading, the market is basically saying the outlook is not much better than it was during the March meltdown. Personally, I don't foresee blowout earnings and a V-shaped recovery, but what I do see is a better than L-shaped recovery which I think will be enough for a revisit of key resistance around 110.
That would be still a pretty impressive move on stock to go from the high 90s or mid 90s, I should say, to 110. We're talking 15% gain. I have one of my own charts here as well that I added to this, and so this is much of a shorter term look, and basically I'm looking for a technical breakout through that 97 $98 key resistance level, the downtrend resistance. On a short-term basis, I think it gets to 102.50, and then after that there comes a major air pocket, and that could take the stock all the way to 115 level, which pretty much coincides with exactly what you're saying in your chart in terms of the total upside. Where would you put your stop on a trade like this? Looking at my chart, I would say that would be around 88 to $90 per share. Is that reasonable?
Yeah, I wouldn't argue with that.
Yeah, so that's been the level where the stock has been bouncing off quite a bit. We got the MACD bull cross, we got the RSI bull cross. We need some more volume though, but the volume could improve as the story unfolds in our view, and the analysts basically get more. Didn't you say what percentage of total analysts are actually bearish on this one right now?
60% of sell side.
Yeah, that's just crazy. That's just crazy. Such a large magnitude of analysts out there. Nobody likes this name anymore. So, and I think there's room for improvement in this one, and the sentiment could change drastically and rather quickly. So, all right, excellent stuff, man. Love it. So, thank you very much for joining. I hope this was nice presentation, and we'll see you next time. Thanks, Chronicle.
No problem.